Thanks so much for tuning in to this conversation with Neelkanth Mishra of Credit Suisse, somebody who looks at the macros and the micros with equal gusto, so to say, and his views on what the budget laid out for the economy at large, and then try to correlate it with the sentiment around the market would be very, very important. Neelkanth, great having you. Thanks for joining in.
Thank you, Neeraj. Thank you for having me.
The pleasure is ours. So, Neelkanth, how did you think of the budget?
Look, the expectation from the government, let's say the prescription that analysts like me have, was that the government should prioritize macroeconomic stability. See, one of the reasons why our economy and our markets have kind of withstood the storm that has been going on in the world is that we are seen as a stable economy. And the expectation from the budget was that, look, let's be cautious, let's be consistent with what our stated framework is, and the government delivered on that. So the commitment to the FY26 target, even the reduction in the fiscal deficit, which was slightly above what would have been ideal, but 10 basis points here and there doesn't make a difference. The numbers look credible. So there have been occasions in the past where governments have stated their intent to consolidate fiscally, but with a 20% growth expected in tax collections and a massive number in disinvestment. This time, all the numbers look credible. The growth number, 10.5%, I think is lower than what I think will happen. I think we'll see nominal GDP growth of 12%. I think the government is at 10.5%. The quality of the expenditure. See, now, just to extend that point a bit further, the government has to do very deft fiscal management in the next couple of years, or next several years, I would say. Remember that our debt to GDP had gone up to 90% in FY21, right? The sovereign debt to GDP, state plus center. Even today, it is 83. Now, for it to fall to 70% as the pre-COVID level, or 60%, which is what the FRBM review committee had said, the primary deficit, which is fiscal deficit minus the interest payments, needs to fall to nearly zero. Just for perspective, it is currently at 3%. So the fiscal deficit needs to come off very sharply now that the economy is starting to stabilize. The problem is if you consolidate too aggressively, meaning you suddenly bring down your fiscal deficit by, say, 1% point or 1.5% point, it can slow the economy down, and then the debt to GDP goes into a very different and a very vicious spiral. So it has to be a steady hand. It has to be a controlled reduction in the deficit with high quality expenditure. So what the government has done is that the savings from subsidies have been deployed into, or they're intending to deploy them into Capex. So there is the savings from food subsidy, fertilizer subsidy, Narega, etc., which are now being deployed into higher Capex. So on all the major points, I think the budget ticked the boxes.
Okay, so a quibble and a compliment, if you will, to that whole argument. One, the quibble is that people are saying that if there's a view that, I mean, you are saying that despite the 50 basis points pullback in the fiscal deficit, which normally would impact growth, you believe the nominal GDP will grow at maybe 11%, 12%, as the case may be. And therefore, the tax buoyancy that the government has assumed is something that I believe you would subscribe to. Why is that?
Yeah, so the buoyancy is, of course, related to the tax to GDP ratio, and I do think that the improvement that we have seen, if you exclude excise duties, the GST as a percentage of nominal GDP and the direct taxes as a percentage of nominal GDP, both are at substantially higher levels now than they were pre-COVID. The question is, if has that trend ended? It would have been reasonable to assume that that trend has ended and we may see a minor reversal this year, that is FY24. The government has assumed that the tax to GDP remains the same, which you can say that maybe it causes a 1-2% swing, that it should have taken 8% growth instead of 10.5% growth. But if your nominal GDP growth is going to be stronger than what they will, so in my estimates, I don't think there is any reason at this stage to worry about it. Now, 2 points there. The first is that as the private sector starts to pick up, right? So as the private sector starts to do Capex, as consumption starts to normalize, the government has to shrink its footprint again. See, we cannot have the government sustaining a very large fiscal deficit. So the reduction in the fiscal deficit may appear to be a, a growth impediment, a headwind to growth, that they are trying to slow the economy down. But at this stage of the economy, to
yeah, I can hear you.
Oh yeah, sorry. So at this stage of the economy, for it to not cause inflation, I think you need to see the government slowly reducing its deficit, right? So that, I think, is an extremely important consideration. So I think that the growth impulse is now coming from the private sector, and therefore the government needs to do less progressively. The second point I wanted to make is that, remember that we still have a balance of payment deficit. So several times in our past conversations, I've harped on that topic, and I think that is still a concern. And remember that our export growth is going to weaken because the world is slowing. The inflow of capital, which is required to finance our current account deficit, is also going to be uncertain in the next 12 months. And it is only prudent that we bring down our balance of payments deficit. The various tools that are available to us to achieve that are higher interest rates. So slightly higher interest rates than what Taylor rule would suggest, so that the economy slows down a bit below potential. And the second is that you have a slightly lower fiscal deficit. And of course, the third is that you let the rupee depreciate a bit, which is starting to do now, because as the DXY has, the trade weighted dollar has weakened, and the INR has held up against the USD, it has meant that the INR is now a lot weaker than it used to be, right? So those things are happening, and therefore you take small steps on every front, and you kind of bring down the aggregate demand so that the BOP deficit is more in control.
Yeah, but the point that I was trying to ask is that you don't reckon that a fiscal consolidation roadmap and a 50 basis points fiscal consolidation will have a large impact on nominal GDP growth. You still are constructive on with the 12% mark.
The 12% that we had was assuming that the government would bring down its fiscal deficit ratio. Remember that everyone is now, once they give a target of 4.5% or below 4.5% in FY26, then all of us assume that there will be a certain graded path to that target.
Sure.
And so it was from 6.4 to 4.5, so it's about 1.9% points. That over 3 years is about 60-70 basis points each. We saw 50 this year. Everyone was expecting 60, but that's fine. I mean, I think the broad direction. Remember, this was the last full budget before the elections, and so all of those considerations have to be kept in mind.
Okay. The other thing is, Neelkanth, and I wonder how you thought about it, is how the budget got labeled as a capex oriented budget and not focus on rural, but for the fact that almost all of the infra projects that are happening kind of give a boost to the rural income per se. So how have you looked at that pull and the pressure?
So the way I see it is that if you have 100 rupees to spend, you can spend that by handing it over to people, or you can build something out of it. And so when you build something out of it, it is not that that money is not going to job creation or people's incomes, right? So if you build a road or you lay a railway track, it requires steel, it requires cement. Eventually, a lot of it then boils down to incomes. So and what these roads and railway tracks do is that they create efficiency. For example, if they say the prosperity corridor from Mumbai to Nagpur is now available, if you are setting up a factory in a much cheaper location away from Mumbai, getting to the ports is a lot easier and a lot less expensive and less time consuming. So I think it's the quality of the expenditure instead of the nature of the expenditure, or rather the quantity of the expenditure, that I would focus on. And I can't imagine how anyone in their minds, when inflation is still at 5.5%, 6%, would recommend cash handouts to people, especially now that the Narega demand is falling, which is a signal that the jobs at the lower income level are now starting to come back. Then you would actually put pressure on inflation and then derail this incipient recovery that is happening. So this, I think, in the bigger picture, remember that if the states do construction spending, if the center does construction spending, the real estate revival is on. I think a lot of construction jobs, which are generally the first step away from agriculture. So as people leave agriculture, the first thing they do is construction. So all of those, I think there is enough in the budget to support that activity.
So therefore, Neelkanth, and I'm bringing in a market perspective here. And then I'll move on to the larger picture, but just trying to get the smaller picture out of the way first. The one common thread of thought, not common thread, but a thread of thought was that consumption-related items, more so rural-focused, are completely a no-go currently. Focus on Capex, focus on manufacturing, banks, so on and so forth. You reckon that might be a mistake?
Okay. So let's put that into put this industrial and Capex related things into two buckets. So one is demand for industrial goods, that is capital goods, and the second is construction. So when you are setting up factories, you buy robots, you buy machines, heavy machinery, you buy boilers, you buy a lot of other things. And when you do construction, you're buying cement and you're buying steel and you're hiring people and renting out machinery, construction machinery. So these are slightly different. So we are positive on construction. We are not positive on industrial goods and capital goods. And the very simple reason for that is that there is a demand issue for goods globally. And just for perspective, our global retail sales proxy is still at March 21 levels, right? So it is still at where it was in 2 years back. Now, since then, a lot of supply has come on because there was a lot of pricing growth that people saw and companies have added capacity. So, and remember that India is the only place where there seems to be steady and strong demand growth. And therefore, the likelihood of imports coming in as global companies find pathways to push that into India. It does not happen immediately, right? Because companies have to find distributors, they have to find pricing, which brand to sell under and all that. Takes 3-6 months, 1 year. But that in the next 6 to 9 months is going to be a risk. And therefore, our manufacturing capacity is not going to be immune from what is actually a global oversupply problem. And therefore cap goods investments, and this is also a very expensive sector, right? So on the metric that we use of how expensive is it versus the last 10 years PE, it is the most expensive sector. The second most expensive is IT. So that's our take. So we like construction. We like the largest construction company. It is part of our model portfolio. Because we think states and center will do a lot of construction capex and real estate is going to do well. On consumption, again, I would nuance it a bit, right? So there is discretionary consumption, there is staples. So there is upper income or consumption which caters to upper income households, and there is consumption that caters to lower income households. Now, if you think about a trend line like this, what happened during COVID was that upper income consumption first dipped a bit because clearly people were locked in. Then as the economy opened up, it went above the trend line because they had pent-up demand and pent-up savings. So basically, this shortage, like people who didn't buy clothes or various things that they didn't do, they had to catch up here, and they did a lot of that. And now they're coming back to trend. So what appears to be a decline in discretionary demand or other weakening of domestic discretionary demand is just reversal to trend, right? So they did too much. It would have been wrong to put a growth number on that, right? So it is just coming back to trend. Low income consumption, because though jobs are coming back, remember that they were the worst affected during the pandemic. As those jobs come back, the first to recover is staples, which is why you're seeing some of the largest staples companies talking about lower income demand coming back. They're calling it rural, but I guess what they mean is lower income demand. So we have positive staples and we remain underweight discretionary.
Great. What about the overall market sentiment, Neelkanth? We are off 6, 7, 8%. I mean, whatever, 8%, circa 8% from the highs in about 2.5 months. Does this kind of take away the lion's share of the big Indian outperformance versus rest of the world, so to say?
It does. So lion's share is a bit hard to say. So I'll tell you. So if you remember our last conversation, so we split market levels into forward price to earnings and PE, and then PE we split into global PE and India's PE premium, right? So 3 parts: India's PE premium, global PE, and price to earnings or EPS. So the forward EPS I'm quite confident on still, right? Because my growth assumptions are quite positive. So we should see. So if a year from now, forward PE, I mean EPS should be about 10% higher, right? 8 to 10% higher at least. The problem is the PE, right? And both components of the PE. So the India's PE premium has now come off sharply. So as China has rebounded, US has rebounded, Europe has rebounded, India's PE premium, which had gone to the world, which had gone to 55, 60%, has now fallen to about 40%, which is still very high. Right? Remember 2010 to 19, the range was -5 to 38 or 35%. So it is still not cheap enough, but a lot of that relative underperformance has happened. Right? So to that extent, I think your point is valid. The global PE is where I still see an issue. So as the Fed has reduced the pace at which it is hiking, so this is what I would call the second derivative, right? I mean, it's a very nerdy thing to say that, there is a first derivative and there's a second derivative. So the slowing of the second derivative is, I think, a bit premature on the market's part, in my view. One should never try to fight the market, but one can look through the concern and look at the concern that the Fed is not cutting rates yet. The impact of the high rates is yet to be seen. And secondly, that the ECB, see, one of the reasons that the trade weighted dollar is back to 100 handle is because the BOJ and the ECB are expected to tighten further, more than what the Fed is doing. And therefore, the average interest rate that the world sees, the weighted average policy rate that the world sees, is going to be the highest since 2007 in a year. So if you remember, 2007 was when all central banks were raising rates because the economy was very strong. Right now, at that time, global sales growth was in double digits. Currently, global sales growth is expected to be less than 5%. So if you have interest rates of that magnitude when global sales are so weak, just like you saw one IT company today getting under pressure because one of their clients has declared bankruptcy, you can expect to see many such companies coming, getting into that kind of trouble. 2 quick points on that. The corporate debt to GDP has risen dramatically from 2010 to 2020. And the quality of that debt has also deteriorated. So the last investment grade rating is the BBB rating. If you slip below that, you become high yield and speculative. That ratio, so BBB or BBB as a percentage of investment grade bonds used to be 32% in 2010. It's at 50% now. So what happens when you have a sustained period of low interest rates is that the capital structure of the corporates changes, and so they take on more debt because you can afford more debt because interest rates are low. And secondly, from a bond buyer's perspective, you start taking on more risk, and therefore lower quality corporates are able to issue more debt. There are a lot of zombie companies. I mean, even in 2014, 15, 5-6% of the companies in Europe and the US were zombie companies. So there are, and then last point is wealth, right? So global wealth to GDP ratio went up from 3.7 to 4.9 in the last decade. Now, some of these things are not sustainable. You cannot be creating like wealth out of thin air just by reducing interest rates, right? So when interest rates stay high for another year, I think the markets may be a bit premature in looking through this period of weakness.
Okay. So then final question before we thank you. So in such a scenario, Neelkanth, would you reckon that that from there is no alternative to there are reasonable alternatives that we probably have already moved towards for global and Indian equities, that equity returns, despite your optimism on growth, would be muted because there are a lot of choices in Indian equities in particular, because China, US, tech, etc. are all options, or
Even
Indian
Europe.
equities, or even Europe, or Indian equities still give strong returns?
So I have never been of that TINA view, because it's a global market. I think people who propagate that view are kind of self-serving, talking their book. They're invested in India, so they keep talking about it. So we've been of the view that the markets will time correct. We started saying that in September 2021. At that time, the markets, the Nifty was at, I think, 3 standard deviations above its 10-year moving average. It has never done that, meaning it has never reached those levels. And so our point was that, look, we are very positive on India's growth. I think India has a great 10 years, a great decade ahead of us, maybe 2 decades if we're lucky. But the market's all pricing it in. Now, I expect, so even in this year's outlook, we stated that, look, we expect the markets to time correct for another year. If that happens, then we would be at 16 and a half times forward end of this calendar year. At that level, I think then the market starts giving returns which are in line with earnings growth, which is, low teens, double digits, low double digits. So, but before that, I think there is another period of a grinding correction. So that's a process which is well underway. I mean, there can be event-based corrections, there can be news-based corrections, there can be, global issues that crop up. But by and large, I think that range will hold.
And sorry, so just one last thing before we wrap up. So you reckon that, I mean, it might be rounding off error, but you reckon that there is some more pain to go, time-wise and price-wise both?
Time-wise, for sure, right? So if you have been in equities for the last 16, 17 months, you made 0 returns. In aggregate, of course, some people would have beaten the benchmark, but and if you were in just plain simple arbitrage funds, you would have made 5% CAGR. And if you were in bond funds, at least over the last, I would say, year or so, you would have made 7% returns. So, and I still think that, and we've discussed this on your show earlier also, that India's equity risk premium being negative suggests that Indian government bonds, which are supposed to be the most risk-free of assets, are actually cheaper than Indian equities. And therefore, it's not surprising that the wealth managers who are recommending bond funds to their clients are laughing their way to the bank right now.
On that note, Neelkanth Mishra, always a pleasure talking to you. Thanks for explaining some of the nitty-gritties of the budget. Lovely talking today.
Yeah. Thank you, Neeraj. Good catching up.
And viewers, thanks for tuning in.